name is Kendall Rawls, and I'm Director of Development with the Rawls Group. In this episode of What's Up with President Biden's Tax Proposals, Jeff Bannon, a succession planner with the Rawls Group, and Kevin Gilbreath, a tax partner with Crowe, discusses, can you sell an asset and avoid cap gains tax? The short answer is yes. Let's listen in and learn how.
Yes, and it sounds a little crazy, but it can be done. And it's it's through a tool that we use that's really common, but oddly named an Intentionally Defective Grantor Trust. And as we talk about these types of trusts, it's a mouthful, I know. It has the word defective in it, but it doesn't mean it doesn't work. It just means that the grantor, the person that's going to be selling an asset and possibly gifting some of the asset to this type of trust, will be the one who pays the income taxes on behalf of the interest transferred. Now, it's an interesting concept, but it is a way for family businesses who are motivated to keep an operating company in the family, have no intention of selling it in the long term, to get that business outside of the estate into an irrevocable trust without using gift tax exemption and without triggering capital gains on the sale to the asset. Okay, that's a mouthful, I understand. But the goal here is to say that take a father who says, I want my heir to take this over, my successor to assume control of this business over the coming years, but I don't want to gift him the whole thing. I want him to have some skin in the game, so I'm going to sell it to him. And if we sold it to him outright, my understanding is that the son would pay capital gains on the interest. Father would pay capital gains on the sale directly to that son. Instead of doing it through a direct sale, we're talking about doing it to a trust for the son's benefit. And because we utilize this certain type of trust, it does not trigger capital gains. Going forward, the son who would be in control of that trust or be the beneficiary of that trust would promise to pay dad back through the proceeds of the assets in the trust to pay off the note back to dad. So dad would have a note for the interest he sold, and the trust would be obligated to pay for the sale going back to dad. In this type of transaction, it's common that the payments going back to dad would be used to pay the income taxes on behalf of the trust. But this can feel like a complex structure at first, but at the end of the day, what you have is simply dad selling an asset, a business interest, to a trust for the benefit of the successor without having to pay the capital gains tax. This could be considered in a lot of cases with family-owned businesses in the right set of circumstances, a tax planning home run.
Yeah. The Intentionally Defective Grantor Trust is a very powerful tool that dealers have used to not place a cash flow burden on themselves and also get some of that value to the next generation. So agree with everything you're saying, Jeff. The only thing I would add on the political spectrum side of things is now is the time to really look at that tool. Does it work for me? Should I be using it? Because we know from some of the senators have put out statements to potential, like Bernie Sanders put out before the 99.5% Act, and he proposed eliminating grantor retained annuity trust, eliminating intentionally defective irrevocable trust, eliminating the use of life insurance trust, and eliminating the ability to use certain discounts that we're used to using. So do I think that they have all the votes to get there? Not yet, but this does give us a little bit of insight into kind of where certain people on Capitol Hill are heading with their tax policy. And it does give us a little bit of more incentive that, hey, these are really powerful tools today that we could use, that we should be talking to the right attorney, the right financial advisor, the right CPA. We should be talking to our financial advisor team to get this done. And now is the time to really look at, is it right for me, and can I get it done by the end of the year?
Right. There's a lot of pressure going on right now, as we talked about, to get as many of these types of transfers and considerations on the table by December 31st. And I'm sure Crowe is feeling the pressure as well of a whole logjam of activity trying to get through the end of the year. So to your point, if we haven't started the process at this point, it's really starting to count down to the final minutes in order to be able to get this done by year end.
It's amazing how many business owners don't realize that there's so many creative strategies at their fingertips to facilitate their vision. It just takes leaning on qualified advisors who specialize in complex family and business environments. Want to take action but not sure where to start? Contact either Jeff or Kevin at the email addresses listed on the screen and leverage our succession readiness survey. A 7-minute investment in time will put you in an informed position of opportunities many business owners overlook, impacting business value, growth, lifestyle, and ultimately achieving your vision. The next episode of the series focuses on when are my taxes going up on capital gains and qualified dividends? Continue listening to the series now or come back for more. Each topic feature may want you to learn something new.